Good morning, I'm Laith Khalaf, Financial Analyst at AJ Bell. Thank you for joining me this morning at our Off the Road webinar. So obviously the start of a new year, so it's a good time, I hope you'll agree, to be thinking about what 2021 has in store. So we're going to look at a few things today, looking a little bit at what happened last year and also thinking about how trends might continue through this year. We're going to look at three main themes. We're going to look at the markets, we're going to look at interest rates, and also taxation, which could be a big feature of 2021. So to begin with, let's take a little look at the markets. If we look at just the kind of background economic picture, this is kind of a rough idea of where the OECD thinks we are in terms of global economic growth, both for 2020 and also projections for 2021 and 2022 as well. So, I mean, you can actually see from that slide that the UK, which is near the bottom there, both in terms of the slide and also in terms of economic performance, we've been one of the worst hit economies over the course of the last year, down there at minus 11.2%. You know, if you take a look at some of the other European economies which have been also hit badly by the pandemic, you've got France there and Italy at around minus 9%. Spain isn't actually on this chart, but the OECD do provide a projection for 2020 for them, which is around minus 11.6%. So there is a bit of variation there between those countries, but actually, you know, the difference is not a huge order of magnitude. Obviously, the UK being down there, you know, writes its own headlines. But you know, 2020 is in the rearview mirror now, thankfully. We're now looking forward to 2021 and 2022, and if you take a look at what's happening there, the OECD thinks that there is going to be broad global growth in both of those years, within the UK and also across the rest of the world, and that is a supportive backdrop for equity markets. Now, it's important to point out that we're not going to get back immediately to where we were before the pandemic. But for markets, of course, it's the direction of travel that matters, rather than necessarily the absolute level. And so an environment in which, you know, economies are growing simply in virtue of, you know, economies opening up compared to last year is one in which it should be supportive of equity markets. Of course, there are risks. I mean, one is obvious, is the kind of course of the pandemic. If it takes a nasty turn, if for some reason vaccines aren't rolled out quickly or are less effective than we think they are currently, then that could be a risk. Also, of course, second order economic events. We think that, you know, unemployment is going to rise throughout 2021. So you know, if that then, you know, creates a feedback loop where it leads to kind of lower consumer confidence, we could get kind of you know, a knock to economic growth, another slowdown at the back end of next year. You know, if you look at this, then actually the kind of economists are pretty confident we're going to get growth next year, but there are, as ever, risks with predictions. So if we look at what markets have been doing, I mean, given what's happened over the last year, it is somewhat surprising to see the global stock market, as measured here by the MSCI World Index, near a record high. You can see there that there was a sharp fall in March, and then the sharp rebound at the back end of last year. Now, there's a number of reasons for that. I don't think, you know, vaccines is one reason if you look at the very tail end of that chart, but actually a lot of the groundwork for the rally was done before that. That comes down to a number of factors. One is markets are forward looking, so they're always thinking about what's happening, you know, over the next kind of 12 months rather than right now. But also we've had huge injections of you know, fiscal stimulus and also monetary stimulus as well. So central banks, you know, riding to the rescue again, throwing huge amounts of money at the problem, and that's, you know, something that, you know, it's a pattern that we are accustomed to. It's been in place really for the last 10 years. There's an economic problem. The central banks, reach for the quantitative easing cookie jar. Markets rally, everyone cheers and moves on. So that's really been the kind of picture of last year in terms of the equity markets. We also have to think a little bit about what's inside the global equity market as well, because obviously the MSCI World is kind of the broad picture of developed stock markets. If you look at how that's made up, actually, a large proportion of it now is the United States. So almost 60% of the MSCI World Index global stock market capitalization is made up by US stocks. And you can see there the United Kingdom is less than 4%. So, that's a very kind of telling picture of where we are. And of course, that has an effect on the performance of the MSCI World as well, which of course is used as a benchmark for many global funds and probably as the kind of most widely used reference point for the global stock market. And if you have a look at the actual kind of individual market performance over the course of 2020, you can see there that what we've got is the US steaming ahead, doing very well despite the huge global economic shock that we had. The Footsie all share, unfortunately, languishing at the bottom there, and Japan and Europe somewhere in between. And actually, if you then just kind of zoom out a little bit and just take a look at the last 10 years, you can actually see that the picture overall is a very similar one. We've got the United States again racing ahead, the Footsie all share, they're bringing up the rear, and Japan and Europe somewhere in between. Now there are a number of reasons for that. UK is home to more economically sensitive stocks, which has hindered it, particularly over the course of the last year. So thinking about sectors like mining, and particularly over the last year, banks, financials, and oil companies. Brexit has also had an effect. Now it looks like we do have some resolution to that at the moment, but that has made the UK a difficult place for global fund managers to put money into because of the currency risk, and also we've seen retail investors shying away from it in this country as well. If you look at retail fund flows as well, on the flip side of that coin, you've got the US doing very well, as you can see. It's enjoyed a robust economic expansion. Some of that is to do with Trump's tax cuts, which took place in at the back end of 2017. But also you have the rise of the tech companies. So if we just take a look at what that looks like, this is this chart basically shows you the market cap of what used to be called the FANGs. Now they're called the FANGMs. That's Facebook, Apple, Alphabet, Netflix, Google, and Microsoft. We're probably going to need a new acronym for this because Microsoft doesn't really fit in there, and Google's not actually called Google anymore. It's called Alphabet. So we've also got potentially Tesla being put in there as well. And as I say, you've got Amazon and Apple and Facebook, all familiar names. But what this chart shows is just how big these companies have become. So we're talking around $7 trillion market capitalization between the 6 of them. And that actually means that they account for 25% of the US stock market. And of course, they've done very well. That's been the case for the last 10 years, as this chart shows, because of the secular trend towards technology. And as we know, that's been accelerated by the pandemic. So, if you think about the services that they offer, the likes of, Netflix, Amazon, Apple, Facebook, more people sat at home, more people engaging in their services is better for them. We've kind of looked at the global stock market. We've then zoomed in on the US, and that's been performing well. And then within that, we've also zoomed in on why the US has been performing well. And that's obviously down to these 6 stocks in large part. And if you also think about the kind of economic backdrop, in a world where the economy is not performing very well because there's a global pandemic on, stocks which can grow their earnings are very valuable, and particularly stocks which can grow their earnings at 20% or 30% are even more valuable, which explains in part the tremendous share price appreciation that these companies had. So in terms of your portfolio or your client's portfolio, where should you be putting the money? Because obviously we've seen kind of a huge inflation in terms of US asset prices compared to in particular the UK. And I think you might be thinking about kind of allocating more money towards the US. I'd probably say that this chart is a bit of a warning sign of what that could mean. This is the Shiller Price Earnings Index. So what this is, it's a broad index of the US market. It's a very long-running series, as you can see there. It goes back to over 100 years, in fact. So what this is telling us is basically this valuation measure is very elevated. So just to explain it a little bit, it takes the price of the US stock market, or the stocks in the US stock market, and then, like a normal price earnings ratio, it divides it by the earnings of the companies within that index. Unlike a normal price earnings ratio, first of all, it's using across a broad range of companies in the stock market rather than just one. But also it takes earnings over the last 10 years and increases them with inflation. So the idea here is that what you are getting is a kind of more rounded version of a P ratio, because it's not just looking at kind of 1 year in isolation where perhaps earnings can be can have a blip up or down. It's taking a kind of view over a more robust 10-year period. And it's put together by Robert Shiller, professor at Yale University, Nobel laureate economist. So it has a lot of academic pedigree to it, and it's a very widely watched measure of valuation. And what you can see from the chart is that it currently sits at 33 times earnings, and that level has only been breached twice before. Once was briefly in January 2018, again just after those Trump tax cuts came through for corporate America and helped to boost stock prices. And also, as you'll see there, when it was much higher at the height of the tech boom at the end of the 90s. And obviously that led to a very big market shakeout afterwards. The data goes back far enough that you can actually see the Wall Street cat crash on there. So that level, the kind of 20s boom, we've gone past now. So I mean, this is only one measure of valuation, but it is a widely watched one, and it is kind of flashing a red signal right now. And I mean, bear in mind that we have just had a $600 billion company, Tesla, join the S&P at a price earnings ratio of 600 times last year's earnings. You can also see kind of what looks like anomalies in terms of valuations of some companies. Of course, many people will tell you that Tesla's worth that because it's going to grow hugely over the next 10 years, but the valuation measure is still elevated. So I think if we then take a look at the next chart, this really kind of puts in perspective what that valuation measure means. So what we've got is the same line, the same blue line there, and we've kind of overlaid on top of that the returns that you get from the US stock market over the next 10 years. So for each point on the x-axis, you've got the valuation of the US stock market, and then the returns, annualized returns over the next 10 years. And you can see there's a fairly strong inverse relationship between the two. So and this stands to reason, of course, the lower the valuation at which you enter the market, the better the returns over the next 10 years, and vice versa. The higher the returns that you, sorry, the higher the valuation you enter the market, then the lower returns over the next 10 years. You know, that tells us again that, you know, this valuation measure is flashing red and is also going to potentially affect returns over the longer term. Now, in the interest of balance, I think it's very fair to point out that actually you could have made this same argument for a number of years now. And many people have, looking at the US market and saying that it's overvalued, and looking at this measure and saying it's flashing red, and actually the US market has continued to rise, and that's, you know, that's a very fair point. And you know, the trends that we've seen in the market have been going on for a long time now. Now, partly that is explained by what we've looked at already in terms of the kind of the composition of the US market, the shift towards those big tech companies, which are not only big but able to grow their earnings at a considerable pace, and that increases their valuation, of course. But we also have to look at the kind of interest rate backdrop as well, I think. Now, this is the, you know, this is the picture of where interest rates stand right now, and where they've come from. So this is the US 10-year government bond. You can see it's at or near a record low, as we know, as a result of ultra loose monetary policy. And, you know, that's really the story of the last year, and again the last, you know, 10 years. You know, with central banks again boosting liquidity, and you know, reaching for the QE bazooka, firing it in markets and lowering bond yields. And of course, what that does is it gives investors very few other options apart from equities, because if you have a government bond, the US government bond, that is offering you, you know, 1% or less over 10 years, you know, that's less than the target rate of inflation, then that doesn't look particularly appealing. And so investors are left with little other alternative apart from to turn to the equity markets, and, you know, particularly stocks like the tech stocks, which are growing strongly. Now, you know, as you can see from that chart, that trend has been going on for a long time, as you all know. The question is, how long can that continue? And the answer to that probably is for some considerable time to come. If you think about you know, monetary policy going forward, you can see on this chart we've continually plumbed record lows, and every time, you know, very rational people have said, well, that's it now, the bond market has had its bull run, and the next move for rates is upwards. I think it was back in 2010. You know, some of you may remember Bill Gross, who was at the time at PIMCO, and the, you know, biggest bond managers in the world, said that the UK gilt market was sitting on a bed of nitroglycerine. He said at that point yields were at 4.5%, much higher than they are today. So, you know, that capacity for rates to crunch lower and stay low has really confounded commentators for all of the last decade, and we shouldn't underestimate the potential for rates to stay low from here forwards. I mean, particularly when you think about the economic environment. Yes, we are expecting economic growth next year, but we know that that is going to be against a backdrop of, you know, very steep fall over the course of 2020, and also you know, a lot of measures perhaps going in the wrong direction. We're expecting rising unemployment next year, and particularly with the kind of pandemic still, you know, raging, and the course of that still not being clear, then, you know, central banks aren't likely to want to knock economic growth for any foreseeable time to come, by raising interest rates too quickly, and that's, of course, you know, means again that is probably supportive of equity markets, and again probably means, you know, despite what we've looked at in terms of the valuation measure, that the trends that have propelled you know, the US market to record highs probably still have some legs in them. Of course, you know, nobody wants to be caught out when the music stops, but that doesn't look to be happening anytime soon. So there is this kind of very difficult question, I think, about how you allocate money to the market, because in the UK investors are generally very underweight the US market, despite fund flows over recent years going towards global and US funds. Actually, UK investors, fund investors, tend to be underweight the US market and overweight the UK market. That may mean that you think, okay, well, it's time to tilt towards the US, and you do have to have a think about that. It doesn't seem like necessarily taking money from one area which has been badly burned, putting it into one that's done very well, kind of goes against the grain of most good investing habits. But it is worth having a look at kind of client portfolios and see just how overexposed they are to the UK, because that is really a legacy issue of, if you think back 10, 20 years, what were the most popular funds? They were UK funds, they were UK equity income funds. And the big names of the past were people like Neil Woodford, of course, who ran a UK income fund, Bill Mott, Credit Suisse, some of you remember, people like Richard Buxton. These were all UK funds, and all that money is still sitting there. But it doesn't seem like a particularly opportune time to be moving from one to the other, and I think probably that's particularly the case because now we do have some resolution to Brexit as well. That could again unlock some more interest from global investors in the UK stock market, because don't get me wrong, the UK economy still has challenges, the UK stock market still has challenges, but that does remove a big area of uncertainty, particularly around the currency. And as I said, in a kind of environment where we do have economic growth, that should be positive for economically sensitive stocks as well, of which we know the UK has its fair share, more than its fair share, and that should again move perhaps from being a headwind to being a tailwind. So, I think for the question of geographical allocation is a very difficult one, because it's not like asset allocation where you've got bonds, equities, cash, potentially gold, and other assets, property, in which you've got kind of assets which perform well at different times, have different levels of volatility and lower levels of correlation. When you're talking about allocation between geographical equity markets, then you are talking about assets which are fairly highly correlated and which have similar levels of volatility. So the question is much more difficult. And of course, probably the most important thing to do is to have some kind of policy, to have some kind of way of deciding on where to allocate geographically, and agreeing that with clients. And that may just be as simple as to say, well, we're sticking to the MSCI weights. And just whatever that is, we're not going to relatively underperform the global stock market as measured by the MSCI World Index too much, and perhaps looking at making creating outperformance by other means, i.e. stock selection through active funds. So, I mean, that's the kind of picture if you look at the global stock market. If we return to this slide, so you would have to have a kind of a benchmark neutral weighting. You'd have to have almost 60% in the US. As I say, it's a thorny question, but that doesn't look like a hugely balanced portfolio. But hopefully that's kind of given you a little bit of food for thought in terms of kind of the drivers of the performance of the world index and how that might sit against kind of client portfolios as well. And this is, as I was saying, how we are looking at this is some analysis that we did in terms of how fund investors sit in the UK compared to the global index. So you can see there is a very big underweight there in the US, and that's almost all replicated in an overweight in the UK. And you can see again at the bottom there what that's meant over the last 10 years is the US has really been the place to be, and the UK really hasn't been the place to be. and that will have had a big impact on people's portfolios. And again, quite a lot of that will be in terms of the currency, because these returns are in pounds. So there was that big devaluation of the pound, but that's not all the whole story. And so we do have to have a think about how portfolios are constructed in terms of how how you go about kind of squaring that circle, and thinking about whether you're happy to continue with the UK underweight, because actually there is a sign that the US is overvalued, also that the UK might have some green shoots of recovery coming to it, while also understanding that does open up the opportunity, the possibility of relative underperformance compared to the global index, because you are so heavily underweight, and we know that the trends that we've seen don't look like a bit baiting anytime soon. So, of course, within the UK market, that is not entirely a homogenous group. We have had some divergence in terms of market performance within the Footsie All Share. So you can see actually over the course of 2020, small cap was very much the place to be. The big large caps suffering again, in part because of their economically sensitive nature. And again, if you look at over the course of the last 10 years or so, actually, small cap and indeed mid cap have been the place to be, and that's the case over the long term. And as you will all know, that actually the kind of small and mid caps do come with high levels of volatility, but actually the kind of returns have been greater. So also within kind of geographical allocation, you need to think within the UK market how much you're allocating to the big large caps compared to small and mid cap, and also within that part of the consideration there is what you're doing in terms of your active passive allocation, because again, small cap in particular is a place where active managers can really apply their trade quite successfully, because it is an under-analyzed area of the market. And so someone coming with the huge resources that a fund manager normally has to bring to bear on a small cap portfolio can be a really powerful driver of returns. And again, I just wanted to kind of reinforce the kind of course of the last 10 years. So last year, 2020, what's happened. There was a big market crash in the UK. And we've seen that in terms of the overall picture, in terms of how the market's been a laggard on compared with global peers. But actually, if you're a regular saver, it hasn't had that big an impact, and that's of course because of pound cost averaging, but also because there's money going in, every month rather than at the start of the period. So, I particularly think that's an important point, particularly for cautious investors who are perhaps still worried about investing in the stock market. A good way around that is to say, well, actually, you don't have to put a lump sum in right now. You can spread your investment out, and therefore you're taking significantly less risk of a market fall just after you have invested. So that about kind of wraps it up for the market section. I wanted just to take a quick look at interest rates. We've kind of talked about them a little bit in terms of the global perspective. Probably wanted to just hone in a little bit more on what's happening in the UK. And what you're seeing here are forecasts for a number of measures, but CPI inflation, the consumer price index, is probably the one that is relevant right now. As you can see, I mean, there are a number of different organisations providing estimates here. In all of them, inflation remains very much under control, and not really going anywhere above the kind of 2% target the Bank of England has. And that means, of course, that the Bank of England has less pressure to raise interest rates. So there are obviously risks with an inflation forecast. If you look at, for instance, this year, we know that inflation is going to start annualizing from the post-pandemic era. So from this March, we're going to see big falls in fuel prices falling out, and that will have some upward impact on inflation. But as we know, the central bank is pretty well versed in looking through temporary blips in inflation like that. We also know that kind of a number of kind of, economically, things that are going to slow down inflation are probably going to be coming through this year. Unemployment is one of them, as you can say, the estimates for that rising throughout 2021, restraining people's incomes, consumers' ability to spend in the economy, and we also have the fact that a lot of businesses are recovering from the global pandemic, and in that scenario, you have to ask how many of them are really going to want to push through price rises in an environment where that might mean losing customers. And that's particularly the case, of course, in a technological age where it is very easy to compare prices in a lot of different goods and markets. So that kind of inflation picture, leads on really to this kind of projection for interest rates. This is just a snapshot in time. It does change, but this is how the market, the interest rate swaps market, sees the prospects for UK interest rates over the next 18 months or so. So, I mean, if you look down at the very bottom measure there, for instance, what you're looking at is what the market is saying is pricing in as a probability of a cut and no change to interest rates, and also a rise. So, over the next 18 months, the market is basically saying that it's expecting rates to stay the same, with about pricing in a 2/3 chance of that being the case. Only 2% chance of a rate rise, and actually a significantly higher chance of a rate cut of 1/3 over the next 18 months. So that kind of tells you the kind of markets are not kind of really expecting anything in terms of rate rises for the next 18 months or so, and that we're stuck in this kind of lower for longer scenario, as we were suggesting earlier, and that may mean that the kind of trends continue, and that actually what this is saying is actually markets view the risk to the central scenario, which is for rates to stay the same, to actually be to the downside, and actually that if anything, they're saying there's going to be a rate cut. Now, of course, markets don't get it right every time, but that kind of gives us a picture of what the sentiment is at the moment. And perhaps how that kind of feeds through into personal finances, of course, through the interest rates that people get on their cash. And actually, if you look at what happened in 2020, it was a fantastic year in terms of inflows into cash products. Now, that was largely, of course, a result of the fact that for many people, a lot of their spending dried up. It was enforced that their spending dried up, but they didn't have. A lot of people still maintained their income because they kept their jobs, and were able therefore to save money because the stuff that we all spend money on, going down a pub, going to restaurants, going out to the cinema, was no longer an option. So that's led to this huge bulge in terms of the amount of money. So 111 billion pounds saved into cash accounts over the first 10 months of 2020, and on top of that, actually, this number doesn't include around 40 billion pounds worth of national savings and investments as well. So there's a huge amount sitting in cash there. And a lot of these people are going to be accidental savers. That that money's just gone into the bank account and hasn't gone out. So it's just built up and built up. So there are conversations to be had about that amount of money, and that's particularly the case because, as we've seen, of the low interest rate environment, here are some of the kind of key rates that you've got for not kind of bank rate, but commercial bank rates available to retail investors. And you can see that what you're getting here is extremely low rates, and below the rate of inflation, or certainly the target rate of inflation. And actually, with inflation rising over the next year, or expected to rise, that's going to look worse and worse. And then another way of looking at it is to look at the amount of money held in non-interest bearing accounts. This is just money sitting in cash accounts which aren't paying any interest whatsoever. It sits at 215 billion at the moment. Now you can see that actually the big increase started back in 2008, 2009, the financial crisis, of course, and interest rates being cut to that emergency level of 0.5%, from which we've never recovered. So there's a huge amount of money sitting in cash that's being unearned. So there are conversations that need to be had around what's happening with that cash. Is it there for an emergency? And for many people, building up an emergency amount of cash is an important thing, of course. But beyond that, if you do have clients who obviously are sitting on huge amounts of cash, and it's more than they need for kind of the emergency of losing a job or some unexpected spending, then it's likely to be losing money in real terms, slowly, but surely, and over long term that can be a real eroder of value. And so there is a question of how do you get value from that money? Well, first of all, of course, is shopping around, perhaps looking for fixed term cash products which offer a bit better return for locking your money away, and also looking at investing in the market as well. It doesn't have to be 100% in the market with all of the cash, but some of it perhaps. And there's also plenty of conservative funds around for people who don't want to take full market risk as well. So that's that kind of juxtaposition we've got. It's an irony that interest rates are at these record low rates, and there's so much money being saved into cash. So that kind of brings us to the end of the kind of interest rates. Just want to kind of switch across a little bit to look at taxation and what's been happening in terms of public sector finances. Many of you will have seen the headlines, so I'm sure you will know about how dire things are. We've now gone through, the public debt bar being above 100% of GDP. So the government is, in a big black hole in terms of its budget. One of the things that we've seen is, despite that, interest rates are really low. Markets have bought into the fact that central banks can manipulate interest rates to the extent that they want, and that governments will remain solvent. So that's a really big plus for the government, is that the money that they've borrowed has been at really ridiculously low interest rates. And the central bank, of course, has also bought lots of the gilts, and so the government is actually borrowing effectively at bank rate. But there is still a big black hole to be repaired, and the Office for Budget Responsibility reckons that by 2025-26, the government needs to raise somewhere between 27 billion and 102 billion pounds through spending cuts or taxation in order to balance the books. And which number you choose depends on your definition of balancing the book. Knowing politicians, they'll probably opt for the easier one, but that's still a huge amount of money that the government needs to find. And so there's a question of how it's going to do that. Spending cuts don't really seem to be on the cards at the moment. So that means taxation is going to bear at least some of the brunt. The Conservative manifesto ruled out rises to national insurance, income tax, and VAT. So those are three big levers the government can pull. It's possible that they go back on their word, but it probably means that a lot of the burden of taxation is going to be falling on other areas. So, what areas might those be? One bit of very low-hanging fruit looks like capital gains tax. So the Chancellor in 2020 actually commissioned the OTS to report back on capital gains tax, and the OTS, the Office for Tax Simplification, came back and made these three recommendations. So the Chancellor doesn't have to act on these recommendations, but in a scenario where the Treasury is looking to make back some taxation, and it's got a report from an independent tax organization saying you should do this, then that is going to look like a very tempting target. So the government may not choose to implement all of these measures, and probably if it was if there was one that looks particularly draconian, it's probably that middle one, reducing the annual CGT amount from 12,300 at the moment to 2,000 to 4,000 pounds, because as you can imagine, that's going to drag a lot of people into the capital gains tax net. But particularly the other measures look relatively reasonable in terms of where we've been before, particularly equalising capital gains tax and income tax. You only have to go back to 2008 to a situation where that was indeed the case. So it's not breaking any kind of taboo to actually go back and say, well, we need to repair the public finances. We're going to equalise those rates, and there would, we expect, and the OTF recommends some kind of inflation protection along with that. The other area where you won't be surprised to learn there is some speculation there might be movement is the kind of perennial stalking horse of budgets, which is pensions tax relief, getting rid of higher rate tax relief on pension contributions. Now, that does again look like a tempting target for a number of reasons. One, it brings in quite a lot of money. Second, it looks like a progressive tax. Third, it's also can be designed so it's less economically damaging. It's kind of taking money away from future pension pots rather than here and now. So with all the kind of tax changes the government's going to want to bring in, it's not going to want to damage the economy or damage it as little as it can by bringing in those tax rises. So that probably puts the onus onto wealth rather than income, because income is much more economically active than wealth, because people go out and spend income in the economy much more than they do wealth. But there are lots of sticking points here. These are some of the things that I'm sure you will be familiar with, that are problems with actually bringing in a cut to high rate pensions tax relief. I think probably one of the big ones is actually that last one, is the kind of, if you think about the public and media reaction to it, I think would be pretty negative, particularly when you think about who's going to be most affected by any cut to higher rate tax relief. One of the kind of big groups that are going to be affected are doctors, because of the fact that they are relatively high earners and also have final salary scheme accrual or defined benefit scheme accrual, which basically opens them up to potentially large tax bills or smaller amounts of tax relief on their pension contributions, and the government would therefore have to sit by and watch a kind of public reaction to the heroes of the COVID crisis suddenly being slapped with a massive tax for their efforts. So lots of reasons there why the government might not choose to cut pensions, higher rate pensions tax relief, because it's very difficult and it would actually take some time to do it, and it's a really toxic hot potato for any government to try to take on. So we don't know exactly where the axe is going to fall in terms of taxation, but we can be pretty convinced that tax rises are coming, unfortunately. So the question is when. And the March budget, which is now being confirmed from the 3rd of March, by the way, is looking like a good platform from which the government could launch its cleanup plan for the fiscal situation that we've got as a result of the pandemic. So that could be knocked, of course, if the pandemic takes a lurch for the worse. But if things go to plan, people are getting vaccinated, it looks like the health emergency is perhaps receding by that stage, or that the end is very much in sight, then focus you can see shifting to how we kind of get the finances back in order. And we also have to think about the electoral cycle as well. We've got an election coming up, not coming up, it's still some time away in 2024. But if you think about, the government will want to kind of get any kind of nasty tax news out of the way well before that, so that it can start to perhaps rebuild a bit of trust with taxpayers in the kind of in the year before the next election. So that March budget looks like it's going to be a big fiscal event, and the next kind of 6 months, next year or so, probably looks like it's going to be quite a busy time for tax planning, because of the kind of measures that we might get in that budget. I mean, if you probably think about budgets over the last 5 years or so, you probably really have to go back to before the pandemic, probably to kind of the era of George Osborne, before we had any kind of really kind of notable budget action. Really until the fiscal measures we got as a result of the pandemic, and I think 2021 could be another year where we get kind of a big shift in terms of how tax works, because the government's hand is really being very heavily forced to get the public finances back in order. So opportunities for tax planning, opportunities for conversations, but potentially a very busy year as well. So that just about wraps it up for today. Thank you very much for listening, for spending time with us. I hope you found that useful, and we'll catch you next time. Thanks and bye for now.